Today's market gave us a split AI tape, and that's the story of the day. Alphabet got hit hard as investors questioned whether the biggest AI spenders can keep winning the talent war, but Micron and the chip stocks held up because the market still wants the companies that are powering this AI infrastructure. So this wasn't a AI is dead trade today. It was more, and it's AI traders are being more selective. And while small cap semiconductors, biotech stocks, and value tried to rotate higher, rising yields and weaker breadth kept us from becoming a clean, bullish day today. Tonight, we're going to break down whether this was a healthy rotation or whether this was the first real crack in mega cap leadership. Today is Monday, June 22nd, 2026. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's start off the video talking about the most important chart of the day. So you can see the S&P 500 was down 1/3%, still showing a relatively bullish pattern. It's weak because of where the intermediate line's positioned in the markets, below market sentiment, the near-term line position below the intermediate line. So again, we're down 1/3%. The reason why, and this is the chart of the day, is what happened with Google. Google has already been in an intermediate decline, at least flirting with an intermediate decline. And today kind of sent it on its way there. You can see from the get-go, from the last the low up to the high point here, and we can actually extend this here to the to this high point. You can see we've been flirting with that 38% Fibonacci retracement level on this pullback. We've had dark pink shading, which means the intermediate line has been falling below. It's already been below market sentiment, but it's been falling below the chart's midpoints in bearish territory. But we've been kind of holding that 38% Fibonacci retracement. Another thing I like to look for to confirm an intermediate decline is this being below the 200-day moving average and then flipping this parabolic SAR over, which we did a few weeks ago, and now this week we've turned red, right? The 20-week hole has turned red. The PPO has fallen below, 4 weeks ago it's fallen below. So we've had all three things occur, with the last one occurring this current week. So you say, okay, we are definitely in intermediate decline on Google. Now, that's the problem is this is one of the bellwethers. This is one of the few stocks that's been outpacing. I mean, if you look at all the Mag 7 names, they're all showing bearish patterns, as you can tell by the color on the charts here. They're all pretty much all showing bearish patterns, except for a few semiconductors, which we'll talk about here in a second. But Google and Nvidia really have been the two that have been like the outperformers, and been holding up. And Google has definitely not been holding up anymore, as it is breaking down today, like I said, below the 38% Fibonacci, but also below the 50-day. Like, we've been flirting with the 50-day. Today we clearly broke the 50-day moving average, with the MACD and stochastics turning lower and the volume kicking down. And that's not necessarily the best sign. Now, the nice thing is there's very strong support down here, so any kind of decline we may get may be very temporary. But in the meantime, while it is in a decline, it's going to be hard for the market to maintain a strong pattern of bullishness. All right, before we move on, hit like and subscribe so you can make sure that you get all the daily market outlook preview videos. Then click the link there in the top right corner of your screen to read today's full market outlook blog post for free. You get that at marketscholars.com with our free basic account. With that blog post, you get today's headlines, charts, sector rotations, breadth signals, and what traders should be watching for next. All right, let's go ahead and take a look at the other 4 charts. All right, so as I mentioned before, Google wasn't the death of this bull market, because the semiconductor index still did very, very well. As you can see, it rallied 1.37%. It's up to new all-time highs. It had this little pullback down on June 10th, down to the moving average. It has since bounced up. One of the main reasons why is Micron. Micron is going into its earnings here coming up this week with, at $1,200. Now, keep in mind, a year ago, the low of the 52-week low is $103. So this has been way more than a 10-bagger in less than a year. So the chip sector continues to really kind of lift and keep the markets afloat when you have, again, all the weakness that we're seeing pretty broadly across the AI trade. The other batch of strength that we had was actually in the Russell 2000. It was up today almost a full percent. It also got a new all-time high and got a new intraday high as well. In fact, if you look at the PPO there, the MACD, it's ramping up pretty nicely up to a new high point. Again, it's still, as of now, it's still lower both on the stochastics and the MACD. But at least, you're still showing a strong bullish pattern, dark green shading, the green line coming. I mean, the last two bull tags have been relatively bullish. So that's another sign of kind of underlying strength in the market, even if the headline, the Google headline kind of showed a weakness there. One of the reasons why we're struggling in some areas of the market is the 10-year yield. The 10-year yield is ramping back up again, back up to 4.5%, back above the 30-day moving average. It's a pretty good short-term sentiment pattern there as the near-term line is crossing the intermediate and moving its way towards the upper reversal zone. If you look at the moving averages here for the 10-year yield, you can also see a pretty bullish pattern here as well. Pull it up there. You can see it hit the 50, bouncing back above. The MACD is almost positive itself. The blue line is almost above zero itself, and it's also almost above the moving average there. And so, that along with strength in the dollar can be a headwind for equities. You can see the dollar breaking out there. The index itself is breaking out up to new 52-week highs, even if like the biggest component of that index is not quite breaking down the 52-week lows yet. But you can see you're pretty much right there. The other yellow flag that we continue to see is this a negative breadth. We're still negative on the McClellan oscillator, and that's showing up in another Hindenburg-Ullman. So you can see, like, I don't know why it's not showing here. I think the main reason probably why it's not showing here, we had new highs, we had new lows. The McClellan oscillator is pretty close to being positive, depending upon what chart you're looking at. But we pretty much had a Hindenburg-Ullman Thursday. So there's Wednesdays. We also had one technically on Thursday, and then we had another one today. So even if this chart's not necessarily showing it, 2 out of 3 days plus all of the, this is a lot of instances of a Hindenburg-Ullman within a 30-day time frame. Again, showing just how negative the breadth is with the number of stocks above the 50-day moving average. Having spiked up last week above 300, looking great, but then all the way back down below 300 again and flirting with breaking back below its own moving average. So you can see we're not necessarily riding a nice wave of bullish strength to the upside. It seems like we're just kind of rotating from day to day into pockets of strength that's helping keep it afloat. All right, well, that does it for today's Market Outlook preview. If you want the full breakdown, click that link in the top right corner of your screen or in the description down below and read today's full Market Outlook blog post for free at marketscholars.com. If, like I said, with the basic account, like I said earlier, if you want the full daily Market Outlook video, including the complete chart review, the trade idea, and how we're managing the existing Market Outlook trades, you can upgrade to our foundation tier. That's our first paid tier at $29 a month or $299 a year. Our foundation tier includes the Market Outlook Live, where we get together before the market close, 3:30 Eastern time every day. We place and manage the old Market Outlook trades every single day. It takes about 5 to 10 minutes. We also give you access to the full trade tracker so you can follow the results of these trades over time. Last year in 2025, the total amount that they gained was nearly $12,000. Again, for only $299 a year. It's a pretty good value for what you're getting in those videos. So start with the free blog post, and when you're ready for the full video and the trade process, join us at marketscholars.com at our foundation tier. Thanks again for watching tonight. Follow me on Twitter at David Settle for more content between the videos. We'll see you all in the next Market Outlook.